All right, let's go ahead and get started. I am Ben Green, Senior Vice President of Strategic Growth with Synergy One Lending, your host today. Thanks everyone for being here. More importantly, Henry Cason, the CEO of FinLocker, want to make sure we get to say thanks to you for being here. This is the shift. This is something we've been excited about presenting over the last couple of months that is all about creating customers for life by winning with FinTech. And so again, thanks to the audience, thanks to Henry. I want to make sure to get a chance to give you the proper introduction that you deserve. Henry, for everyone, is the CEO of FinLocker. FinLocker is a wonderful company that is committed to next-gen consumer personal finance. And really, what does that mean? That's something about creating an opportunity for financial wellness and really wealth for consumers across our country through their tremendous technology. And along with that, Henry also worked with Fannie Mae for 28 years. If anyone's heard of Fannie Mae on the call, obviously a large player in what we do and what the mortgage industry and real estate provides to our customers. Over the course of that 28 years, Henry led all things data, led all things technology, was a part of the team that gave us day one certainty and about 1,000 other big wins for the industry along the way. So with that being said, Henry, thanks for being here, my friend.
Hey, Ben, thank you for having me. I look forward to the conversation today.
Well, it's a privilege for me. It's a privilege for everyone that's on the call. We got a lot to learn from you. So let's go ahead and get started. And the lead question that I have for you is a little bit selfish, but I bet I'm not the only one on the call that feels this way. We talk about FinTech, and I use that term often. A lot of folks in origination and real estate use that term often, but self-admittedly, I don't have a great grasp on the definition of FinTech other than to know the fin means financial and the tech means technology. So I was hoping that you would give us a much more educated definition of what is FinTech, what has it been, leading up to this moment in the mortgage industry, and just kind of walk us through, again, a little bit more educated description of FinTech and the role it plays in mortgage and real estate.
Yeah, you would think leaving Fannie Mae and going to work for FinLocker, I would have that definition in my back pocket. I don't, right? I think at Fannie Mae that we were very broad in that definition, right? And we looked in the sector, especially mortgage finance, and we segmented financial companies, and those could be long-standing financial companies or early-stage startups, and then classified them within their respective sort of areas, whether it's marketing, pre-point of sale origination. And so at Fannie Mae, we had a very broad definition. It was really who's providing technology in this space and how our customers of ours at that time, lenders, were using that technology. I will say this, and a lot of the comments I make today are going to be from my point of view of working at Fannie Mae for a very long time and seeing the industry on a broad basis, right? I got to see lots and lots of customers, lots and lots of technology providers, Fintechs in this space. And I think first I'm going to say Fintechs have been a game changer. And I don't think that's an exaggeration. Coming out of the 2009 financial crisis, our industry was saturated with what I would call rescue and recovery work. Work on asset quality, servicing default management. I know at Fannie Mae, we spent a lot of time on that. The rest of the B2C industry sectors like retail, consumer banking, media, and other industrials jump much quicker into technology-driven transformation of their businesses, while mortgage and the mortgage industry lagged. We had to recover to get back to stable balance sheets before innovation investments could be made. And with demographic shifts in the housing market, consumer expectations and comfort with technology has dramatically increased. Millennials and Gen Zs and the early waves of Gen Zs are beginning to become the core of the housing market. And these consumers are most certainly digital first, mobile first, and drove and will continue to drive some of the explosive FinTech growth we have seen in mortgage specifically. I think there's three key areas over the last 5 years where I've seen FinTechs make a dramatic impact on the mortgage manufacturing process. First one was the emergence of what I would call these digital natives marketing and POS systems. And these fintechs transform the consumer experience in mortgages through very intuitive and sophisticated point of sale systems. These POSs drove convergence of CRM, marketing, and prospecting, and loan application business processes, and created very high impact mobile and direct to consumer solutions. Second area was innovation around digitization of core data and attributes, like employment, income, and assets that that do drive the risk assessment of any loan, and truly transformed how high quality data is captured and managed for the underwriting business processes, and allowed for things like you mentioned it, day one certainty. Without fintechs and without the ability to go grab and normalize this data, we would not have been able to launch day one certainty, or if we did, we would have had to go out and do it ourselves, which would have taken a lot more time and a lot more expense. And then lastly, around the automation of business processes in the fulfillment space, with lots of work around operation streamlining, RPA, robotics process operation, e-notes, and e-closing, that is beginning to reduce cycle times and improves operational efficiencies. So huge impact over the last 5 years. I would say that most fintech companies that I've run across, don't focus on the full gamut. They're highly focused on solving, one or two problem areas of the loan manufacturing process. A key trait that I saw at Fannie Mae, successful fintechs are ones that truly rely on strong partnerships, and that strong partnerships are like the ones we saw when I was working at Fannie Mae between fintechs, our lender customers, and the GSEs, and combining that partnership with true test and learn, and ultimately relying on the people on this call, loan officers, realtors, processors, underwriters, relying on your expertise to orchestrate the insertion of this technology into the end-to-end process, and making that end-to-end process better, not just for the companies themselves, but for consumers. And we've seen a dramatic impact on the ability to help consumers navigate this process much better over the last 5 years than the previous 5 years, for sure. The other thing I'll say on this is, and for those of you who've heard me speak before, I say this a lot, you can't just buy tech and expect it to work, expect it to win. You can't just plug tech in and expect it, you to become profitable tomorrow. You still have to understand what your strategy is. You still have to understand your channel strategy, the operational processes, and then figure out ways you can insert multiple pieces of technology through multiple fintech providers to solve small problems, medium-priced problems, and big problems, and bring a holistic offering into your consumer base. To me, that's where the magic happens. And then lastly, I'll end with this. COVID-19 or the last year has sort of been the proof in the pudding, in the sense of this. We had very high volumes the last 8 to 10 months. And what I saw was an industry was able to sustain and support these unforeseen volumes of origination, and did very well, admirably well, for a matter of fact. And I think it's thanks to a lot of the fintech that has been integrated into all of these customers or lender partners processes. And then, during COVID, we have some additional accelerators kick in around closing in an e-note space that, also had a positive impact for the lending community. And so I'll just finish it up with what I said before. I absolutely believe fintech and fintech companies have been a game changer, and I expect that to continue for the next 5 years.
Wow, that's wonderful stuff. And I know we talked about that a little before the call, and we're excited to dig into that a little bit later in the presentation, and really dig into the benefit that we've seen, whether we acknowledge it or not. But that being said, there still can be with some an understanding, be it accurate or just in their own beliefs, that big data has created a scenario where we're going to lose our customers because of that data, and we're also going to that CRM component, that marketing component. How are we able to own the benefit that has brought to the industry, and how can we make sure as retail loan officers, as hardworking realtors, to make sure that doesn't get taken from us. And that really is, the shift. Again, the title of the show, and something that we take very seriously, is what is the shift that big data has brought to us? And I know that you believe that there's an opportunity for that shift to be from a one-time transaction between realtor, mortgage individual, home buyer, refinancier, to a lifelong consumer. And yes, that can be a little bit cliche. That's something that I know we've all fought for generations, right? We want to have that consumer for life. But I know that you again have the expertise to kind of walk us through how that can really happen in this moment with the data that's being provided by FinTech. So do you want to help us a little bit on that topic, please?
Yeah, so I this is an interesting topic for me, because as I was sitting in my last year at Fannie Mae, and looking at all the things that we did to drive innovation in the industry, I wanted to begin thinking about, what is the next paradigm shift or the next frontier for mortgage? I just went through 5 years ago where we really transformed the mortgage industry with the introduction of a large scale number of fintechs in the ecosystem. And for me, one of the reasons why I left and chose FinLocker, and that will probably be the last time I mentioned FinLocker on this call, but was, giving me the ability to affect the shift. And what do I mean by that? I don't mean this as a negative, but the mortgage industry is really very transactional. Yes, you're out there trying to acquire leads, but you get a person into the process, and once they get that loan, they go into someone's servicing portfolio, and you move on to the next one, right? And I really have began seeing this shift from one of transaction oriented to retaining for that consumer, that customer. We can call it customer for life. And it's really being emerged as a key competitive battleground as originators and realtors look to differentiate themselves as an advisor rather than just being someone who is going to close your loan. And the shift is driven in part by outlook for our business post-COVID, consumer expectations for service and for sustaining quality, pricing, and margin. I think technology or fintechs also afford the opportunity for realtors and LOs to play more of a trusted advisor role while automating very mundane manual processes. So let me go through a couple of reasons why I think this shift is important. First, very low retention rates in mortgage on refis for servicers, astronomically low. I think in the recent Black Knight report, we're in the high teens, and then down to 12% if you just look at cash out refinances alone, which is kind of crazy, right? Because lead or customer acquisition is really expensive, and you've got this customer that is attached to your brand and paying on a monthly basis. And I think as rates continue to move up and refi volumes stabilize or drop, borrower retention in this subset of consumers is going to be a necessary business lever. I also think, we are going to be moving into a strong purchase market the next 12 to 18 months. There's also been an increase in homeownership tenure, meaning people are staying in their homes longer. And so borrowers staying in their homes longer, combining this with the shift of the purchase market, is going to create an environment where rates are rising, margins are being compressed, and matching that with continued low level supplies. You're going to see business impacts if your business has been built on volume and throughput, especially if you have high fixed costs. So a lot of the lenders, over the last year that I've talked to and got to visit and spend some time with, are looking at ways that in both from an origination and a servicing business, how can they move way up the funnel, and how can I create better retention strategies on the back end of my business? And I think technology, particularly fintechs, can help significantly in this environment. Realtors and loan officers have the ability now to move way up the funnel to capture consumer early in the mortgage process, and in some cases, and in lots of cases, based on your own consumer data footprint. We all have them. We know what your buying we know what our buying patterns are. We know a lot about you already. can really get to those consumers well in advance of them being ready, or even inserting themselves into the mortgage borrowing journey. And then the other way I think about this is, if you're a servicer, your servicing book can and should be the top of your origination funnel. And so, fintechs can really add scale to your business and create more variable capacity, which I think is really, really important, and it allows you to move up or move down your volumes with less incremental cost, and a much lower fixed cost, and give you all the tools and capacity becoming what I consider to be the next frontier. Is consumers like to attach themselves to well-known brands, and they like trusted advisors, especially the consumers that are showing up today. And it allows you to spend more time on those actions than dealing with all the mundane tasks that it takes to either sell a home as a realtor or begin a mortgage process and get that process closed. I think fintechs can most certainly bring better data, better analytics, and better integration between your various, what I would call back office system, your loan origination systems, your servicing systems, your pricing systems. It most certainly can help you rethink your lead gen, and the integration between lead gen and loan manufacturing. And most importantly, I have seen a shift to, keeping your client roster active, and ready to go, because at any point in time, that consumer may be ready for a mortgage, and you know more about them than anybody else, and you're able to offer them in real time based on their financials, based on their identity, offer them the right solutions at the right time, and offer those solutions with certainty, which I think consumers are looking for. And if you haven't had a chance to read, there's a really good Housing Wire article by Grant Moon. I think it was back in mid-2019. If you haven't read it, take a few minutes to read it. It's titled "How to Solve the Mortgage Customer Retention Crisis." And I think what's really cool about this article, it highlights a near, 4x improvement in retention using fintech-like integrated technology and marketing for your servicing customers. That's just one example. I don't want me to harp on servicing, but that's just an example of where you can get much more precise, based on fintech and technology techniques, and combining that with the data you know about a consumer and the data that the consumer wants to share with you. So summarize, I think longer term profitability in our industry will have to reconcile with volume-based models with service and retention-based reality. And I think fintechs can provide you that scale and flexibility.
Wow, that was some fantastic stuff, and it leads into, again, a couple other really exciting topics. I want to take you bringing up that Housing Wire article as an opportunity to share what I stood of at the start. There will be a recap of this that we'll get a chance to send out to the attendees or those who may have tried to get here and just had their day get the better of them. So that will be included in the recap. We'll make sure of that. And additionally, for questions or additional items of interest that are coming up from some of what Henry's sharing, we have saved a few minutes at the end, and there is someone monitoring the chat box. So do feel free to go ahead and plug those in as you see fit, or whatever hits your mind. We'll try and address those over the last few minutes. But you hit on the next frontier, and I think that's what a lot of folks are really here for, right? And when we think about next frontier, at least myself, and I'm going to guess others, we think of who are those big data companies, whether it's Zillow, whether it's Amazon, whether it's Apple, host of others. But what is the impact that they're having on our lives today that we may or may not already know about? What are they really trying to do in mortgage and real estate over the next few years? Who knows? I've heard a million different opinions. I'm sure you have as well, but I'm super interested in yours. If you wouldn't mind just kind of talking about the impact that those big data companies have on, as you described it, the next frontier.
Yeah, great. Thank you for that question. It's funny. I think every year we would be sitting at Fannie Mae saying, "Oh my God, what is Amazon doing? What is Amazon doing? What is Amazon doing?" And I think we quickly realized, wait a minute, that's really not the right question, right, to be asking. And we started diving into it a little bit deeper, and we saw the Amazon effect, and I'll abstract it out and use the words big tech to be fully inclusive, because it's not just Amazon. And I'll try to break that question and talk about it in two dimensions. One is indirect benefit, that we've seen to date, and then discuss potential direct entry into the market and impact. So from an indirect perspective, let's talk about digitization of our end user experience and data-driven business, right? So the big tech effect in aggregate has been fantastic for consumers and therefore our industry. Like I mentioned earlier, our industry had to get a digital, to match the experiences being offered. Amazon and Uber and Google and all these things have taught consumers things like instant value, instant gratification, certainty of the transaction, and so on. And that's what consumers are looking for. And the stuff I mentioned at the beginning of the call are all things that are a direct benefit of what big tech has been able to do in other industries, including their own, right? So the innovations I mentioned earlier with point of sale, our data validation services at Fannie Mae, or e-closing e-notes, were all accelerated by the big tech effect, for sure. So I think we owe them a thank you for pushing us into the digital age and really getting consumers ready for more digital interactions and conversations in the mortgage industry. And a large number of brokers, loan officers, and realtors use Facebook, Twitter, Google Ads, search to market and manage their leads, communicate with borrowers in frictionless channels across mobile, voice, and desktop services. All those capabilities are being provided by big tech. So they're in the industry, and they're helping. Big tech has also allowed all of our businesses over the last 5 years to move into what you referenced, Ben, in a data-driven world where there's a continuous refinement of all of our business activity, right from customizing lead generation through product selection and process optimization. And then lastly, in this category, it's fascinating. Most of the fintechs that you see in the industry today, you've heard of family trees in coaching. Well, there's a family tree in big tech, right? And a lot of the fintech founders and CEOs, came from companies like eBay, PayPal, Google. I can go on. There's 100 of them. And I think that's a good thing, right? Startups founded by industry outsiders, I believe, and I saw it firsthand while I was at Fannie Mae, provide a different perspective in solving certain problems and provide efficiencies in a way that a lending company or a very mature mortgage company, which isn't focused on the entire spectrum of their business, may not be able to see or may not be able to implement fast enough, right? So I think it's an interesting perspective of big tech. Second, all of us have been moving to cloud. And so infrastructure and software as a service is born out of big tech, right? And it has created huge efficiencies in the industry, right? Including how we digitize the ability for lenders and servicers, as well as technology providers like us at FinTech. We use this core infrastructure to provide these services. And we can get it at a price point as well as an efficiency point to help us bring this technology faster to market. And with these cloud services, big tech has also been bringing a wide range of new tools and services for image and document recognition that has significantly boosted productivity for businesses in mortgages, including, how you may get data off of pay stubs and the rest of what you need to originate and service mortgages and how they can be digitized and high qualified verified data. All of that has been done through in innovations through the big tech sort of infrastructure. On the direct entry and potential impact, I would say this. Mortgages are a 10 trillion market, right? So with a lot of fragmentation and several other characteristic, value chain optimization, innovation potential, that make it certainly big enough and interesting for any of the big players to take a direct role. So far, I think there's two ways I see big tech as entering or impacting the housing market. Once again, these are my opinions. One is I've seen it through partnerships in consumer financial services, right? Almost all notable financial services offerings, for either from Apple, Amazon, Facebook, or others, have started out with a relationship with financial service institutions and related players, right? And I think that's a key signal, right? Because it speaks to the partnership aspect of what I've been talking about. And initial offerings that we saw were in the payment space, and then we started seeing cards and checking and savings type of services coming in. I see these partnerships continuing, and I expect to see a lot more of them, and I expect to see it start to come into our space. And then number two, with the onset of COVID and social justice, I've seen a very active direct investment and partnerships in the affordable housing space. This second area, we're going to see big tech get more directly involved in housing, is acting on the affordable housing crisis that is impacting their own workforce and communities they operate in. And so you see the likes of Google and Amazon and Facebook and more, all contributing to affordable housing solutions. I absolutely see this trend continuing. And together with financial services offering big tech that has already developed, this second thread will be valuable learning opportunity for big tech, and that will shape how and when they will tackle direct roles in the rest of what I consider residential mortgage market. Most of the mortgage lenders and real estate agents on this call, I don't think should be overly concerned that big tech is going to take your business, take your jobs. I don't think this is what you should be competing with, and I don't think it should be what you should be concerned about. I think what you should be concerned about is if you're not rethinking how you acquire customers and how you service those customers, someone down the street is thinking that way. And someone down the street will be implementing fintech-like solutions to help them grow their business, help them with customer acquisitions, help them with customer for life strategies. And so I think that's the bigger thing, that if you're a loan officer, a realtor, a mid-size to large mortgage lender, that you should be thinking about, and thinking about ways that you can create these technology partnerships, and bringing in technology as a partner and serving your consumer. The technology provider, big tech or other, can offer quality digital mobile experiences to your millennials and Gen Zs. Another example, the prop tech provider can help with virtual tour technology around showing a home. And the doc management fintechs, have made a lot of progress to make e-closings much, much more seamless. These are all capabilities that you can offer to your consumer base, and this is where big tech has really been helping. And then lastly, I'll end with this. Disintermediation by tech, and usually big tech, usually works well in low-value steps of a business process. And a human-centered and emotional investment-based business that we all work in, I can't underestimate the value of a knowledgeable realtor and loan officer, a trusted advisor. I don't believe those can truly be replaced. My opinion or my thesis is that if we as an industry want to move to a customer for life model, deploy the right fit fintech to manage your business, big tech can be very additive, complementary partner. If we remain transactional and do not generate enough value for our paying consumers, much like other industries, there's a chance that you will be impacted by tech in other ways, by reduced margins and lost business. So in summary, I think big tech having a role in the mortgage market is inevitable. They're here, they're already here, they've been here for a long time. And in some ways, in lots of ways, very good for our industry. And I still believe they will need partnerships that bridge that industry knowledge and regional local expertise our industry players bring to complement tech innovation and scale big tech can offer.
Incredible stuff. Appreciate you taking us through that. The perspective is it's very valuable, and that's some wonderful stuff. And you hit on some key points that'll lead into our next topic. I do want to say in advance of that, the Grant Moon article you referenced has now been posted in the chat as well. So again, it will be included afterwards, but for anyone that wants to check that out or grab that link, it's in the chat right now. Thanks to our digital marketing manager, Andrew Haberman, for that, as well as putting on today's show. And the point that you just made that I really want to lead into our next topic on is what's fantastic for consumers is therefore fantastic for us. And this commitment to the consumer is what helps our businesses stay healthy. It's not a one wins, one lose sort of arrangement. And that really kind of goes back into the last point in terms of, what are you fearful of, or why are you embracing fintech? We talk here at Synergy One about a commitment to speed, ease, and expertise, right? That's what we're trying to stand for every day. And that's not because we're worried about Zillow or Amazon or Facebook. That's because that's what the consumer deserves, and therefore it's healthy for our business. And all that being said, I want to get a chance to to transition that to a specific sector in the business growth that I know is something that you're very passionate about, and that is, how does all this benefit underserved markets? We know that there are certain citizens in our country that have not had the access to mortgages, have not had the access to other things that are good for their financial wellness and health. And we want to make sure that we're a part of that solution. And again, I know this one that is very, very important to you. So can we transition that last topic into that specific sector of how do we use FinTech to benefit the underserved as they deserve?
Yeah, this is very important to me. Coming from Fannie Mae, you have this sense of mission that I bring with me into FinLocker, and this is a really, really important topic. And I think it's one every industry participant should monitor, educate themselves on, and manage very closely. The COVID crisis has hit low to moderate income families extremely hard, and coupled with coming out of the financial crisis, historically low supply combined with low interest rate environment drove housing prices up, right? And put homeownership essentially out of reach for millions of Americans. The percentage of Americans owning a home was about 64.8% in Q3 of 2020. But when you view those homeownership rates by race, the disparity is really apparent and shocking in some cases. 75.8% for non-Hispanic white alone households versus 46.4% for Black alone households. And so that is not a viable situation. It's not good. And all of us, no matter who we are, should be looking to do something about it. And so I think there's three areas where sort of technology-led innovations and evolutions can make a difference in the underserved markets. One, technology can help identify the problem, right? I mentioned the impact of technology innovations in moving our industry to more of a data-driven analytical model of serving our borrowers. Data that is highlighting the disparities in income, credit, and housing affordability has been a big driver in drawing attention to the problem and bringing much needed public-private partnerships and solutions to bear, right? So I think just alone the ability to see what's happening, and FinTech and Big Tech and technology providers allow us to do that. Another area that I've been passionate about and spent sort of the last 4 years at Fannie Mae and what I'll be focused a lot on at FinLocker is newer data can serve the unbanked or underbanked much, much better. And so what do I mean by that? Technology and these FinTechs can bring us the ability to leverage newer data sources like rental and utility payments and augment historical credit models, right? This innovation should help address credit score discrepancies and disparities for minorities and low-income families, especially those families that have thin files or very low traditional credit scores. And so I see the next evolution is not just using credit and FICO and sort of that side of the equation, but then how do you start blending in other transactions that you don't see on the credit report, like rental payments, right? How do you start to look at net income versus gross income? How do you start to think about cash flows, right? And how do you blend all those together into a newer way to think about giving credit to someone, especially in the home buying process? And how do you answer the questions better of, can you repay back this loan? And do you have the willingness to repay back this loan? And so I think newer data is going to help that. And I also think with that new data, you're going to see, hopefully, innovation in risk scoring. So once again, complementing the conventional credit scoring models with contemporary data sources that look at employment stability, cash flows, and net income, I think will help alleviate some of the imbalance in making credit available, right? I also see FinTech can help lenders and real estate agents step more easily into a role of that advisor. I mentioned that earlier, to help more consumers and underserved overcome whatever hurdles they have of buying a home and qualifying for a mortgage, and allow us to look at mortgage qualification differently. So helping renters gain access and understanding of homeownership tools at an earlier age, right? So financial education, improve and expand financial education, housing counseling, and homeownership preparation to renters and younger generations. In providing tools to educate prospective borrowers on the importance of checking your credit reports more frequently. There's a lot of technology that allow you to do that. And getting the issues resolved in a timely manner. Don't wait for when you go apply for a mortgage for them to say you've got a low credit score and you've got these 30-day lates or 60-day lates or your utilization is high, right? There are tools out in the industry that allow you to take control of that situation and look to correct. And the earlier you do that, the better off you're going to be over time. Broadening access to down payment assistance and low down payment programs is essential, and technology can help with that. And then strengthening post-purchasing education and counseling so home buyers can establish the right financial habits to maintain ownership of their home. So I think around all these dimensions, FinTech has and will continue to play a big role by making it easier for all of us to work with large amounts of data, applying sophisticated models and analytics that can help identify the right solutions for the right borrowers. And I think mortgage is somewhat always looked at each consumer kind of the same, right? And I think you need to step back and really think of every consumer is on their own journey. They're all different. And what FinTech allows you to do is create that customization fairly cheaply and fairly quickly to address that consumer at that point in time in whatever financial decision they're making. And that could be more than just getting a mortgage. It could be, how do I pay off my student loan debt because I've just graduated from college or gotten out of college? How do I upgrade because I've got a young family into a new home? And I think targeting these solutions and really specifically addressing the underserved markets can make a big difference.
Yeah, that's incredible stuff, and really kind of speaks to the shift that really this discussion is all about, right? And the front end of that is data is coming for my relationships in my business, but when you allow yourself to be educated on it, to think through it, and to see the opportunity where you find yourself is data is providing me the chance to grow my business and serve more people, specifically those that I haven't been able to serve prior to this. And what a wonderful thing to be a part of. So that I think is exactly the.
And I think that mentality, and I'll say it again, right? We need to talk about this, right? There is a problem in this country when it comes to access to credit for low to moderate income and minorities. It's as simple as that. And if we don't talk about it and we don't all work together to fix it, it's not going to get fixed, right? And then secondarily, right, I think it does create more customers, right? And more customers for life. And so, and that's really what I mean about moving away from a transaction mindset to a customer for life mindset. That's a buzzword, I get it. But what are the things you're doing for those consumers who may not be ready for a mortgage? Are you going to wait? Or are you going to help them, right? And are you providing them with capabilities and technology to allow them to get ready? What are you going to do when you have that customer on your books and you're servicing them? How do you know what's next for them, right? And so I think all of the things we've been talking about is really important, especially in the underserved community, especially for those consumers that have either zero credit or thin credit. And if we can all work together, I think we can make sustainable change and start seeing more of that community, partake in home ownership and get on the road to wealth building. So
great. Well, I want to thank everyone that's sending in questions. There's some magnificent questions coming in, so we definitely want to save some time to address those. But just real quickly, and I know this is your opinion, but it's an educated opinion and one that has a lot of experience that has led you to it. Just talk to us briefly about your thoughts on the state of regulation, what might be changing with the new administration in place. Again, I know it's your opinion, but curious your thoughts on where regulation is on the industry right now.
Yeah, so this will be a 30,000-foot view of me personally, who've both been in sort of a pseudo-government role and private role on how I would advise originators, realtors, mortgage lenders. Number one, educate themselves and speak to how especially this new administration is going to impact the home lending landscape, especially when it comes to newer technology advancements. In my opinion, we're going to see one of the more pro-consumer policymaking administrations than we've seen in the past couple of decades. Understanding how the change in regulatory landscape unfolds and being flexible to manage the change is imperative for all of us. And here again, this is where technology can play an important role. You know, we live in a very dynamic regulatory environment. You know, as you saw with COVID, you know, COVID brought forth rapid and significant change in policy and regulation, all the way from monetary supply at the top of the economic funnel and well into the nuts and bolts of the loan manufacturing and servicing by regulating employment and income validation, providing forbearance and eviction relief, you know, and then with the social justice movement starting last year, the issue of affordable housing is front and center, and I anticipate additional regulation and or changes in government's role in that space, right? Especially with the two GSEs. And so, in my opinion, you know, we're also, as much as I've been sort of singing the praises of big tech, I also think we're very far overdue for some big tech regulation, especially when it comes to consumer privacy and consent, right? And I think you know, you'll start to see some of that take shape and form over the coming months and years. You know, all of us need to stay on top of these developments and assess, you know, our business models continuously for embracing the change and affecting real outcomes for our stakeholders. You know, I think, you know, I personally, you know, leading a fintech, you know, we stay on top and monitor developments closely from HUD, CFPB, FHFA, and other agencies, as well as we always look outside the US for developments, you know, especially across the pond in Europe around privacy regulation or open banking and such. And then we have the ability to discuss these with our customers in working sessions and help them understand why we do things the way we do and how to design our systems and business processes to be compliant from the get-go. You know, and so I think, once again, partnership. I'll bring partnership back into this. You know, because this is a very dynamic regulatory environment, having partners that you can discuss sort of what you think we need to make sure we're taking care of and create an offering that does that is very beneficial. I think another way to stay abreast and be prepared for regulation, you know, I'm a big supporter of industry standards, especially data standards. You know, whether you're within the mortgage industry as those championed by SMISMO or broadly in the financial services sector as championed by the likes of the Financial Data Exchange. Common standards help improve our collective resilience and flexibility in dealing with dynamic regulation. Working together, you know, we can also help educate our stakeholders, we mean Fintechs, regulators, legislators, and the like, in representing the many logistical challenges new regulations can have and the unintended consequences that it could result in, right? I think our industry does a fairly good job of understanding the mandates and leveraging key institutions like the MBA and contributing to an efficient regulation, but I think we can always do more. And, you know, regulation can be very complex and costly to get it right. You know, a good example, and it's an interesting example, is that on the topic of cost of originating a mortgage, which is roughly between $8,000 and $9,000 per borrower. You know, a good portion of that cost, you know, as most lenders that I've talked to would say, and as the data is borne out, is the cost of compliance and regulation. You know, is this cost excessive? Should we look to drive down and lower and pass the benefits to consumers? Yes. But also, you know, is the compliance the main reason why we have a lot of servicers, you know, pre-COVID had very healthy servicing books in terms of defaults? And would that default rate be much higher if we had a much more lax view on compliance? So I guess the point I'm trying to make is there needs to be a middle ground there. We should always stress the boundaries of is there too much compliance? And then once we find out what the right compliance is, using your tech providers to help automate that and help ensure that you're getting the benefit of all the technology around there, so you don't have to have humans make those reviews or consistently be involved in that. And so I think our challenge is to maintain a strong compliance regime, but also reduce costs along the way, and hopefully transfer those efficiencies and cost savings down to the consumers, which also plays well into providing the right value to your consumers, depending on what other financial instrument they want to sort of participate in over the life of their financial health and wellness.
Fantastic. And you know, you've hit on partnership throughout, and I just want to draw a little bit more attention to that because, you know, a lot of the folks on the call are partners in the sense of realtors and loan officers work very closely to establish their businesses every day. We all know that. And partnership is something that we take very serious. Well, there's an opportunity to have an additional partner take us to new levels, right? That's, I think, what you're going for in terms of using data and technology as an additional member of the partnership circle, so to speak, versus the enemy trying to break up the circle. And I appreciate your thoughts on the compliance aspect as well.
Yeah, Ben, on the partnership side, let me just say this, right? I've always been a believer that the more diverse opinions you have in the room, the better you're going to solve whatever problem you're trying to solve, right? And so the example I always like to use, if you have 10 Henrys in the room solving a problem, you're going to get that problem solved, but it's only going to be solved one way, and it may not be the right way, right? And so what these partnerships bring, especially if you can create trust around these partnerships, they bring a bunch of diverse opinions in the room. And some of the most fruitful partnerships that we had at Fannie Mae were customers and Fintechs and Fannie Mae, all of us getting together and solving the problem together, because each entity or each group or each person in the room brought a different perspective, asked a question in a different way, which unlocked better discussion and better opportunity to solve the problem. And I think in a nutshell, that's what you get with Fintechs. You get a bunch of creative people who are dedicated to solving a problem, whether it is in prop tech, because I want to fix appraisals, or whether it is in verification of employment income and assets. And by bringing in the policymakers like the GSEs and HUD into those conversations, you can have a holistic way to solve problems. And it's something that I truly believe in, and it's something that I've seen work in action. A lot of the stuff we did under my tenure in digital at Fannie Mae was done in concert with Fintechs, with technology providers and customers. We just didn't sort of say we're going to solve the problem this way and throw it over the fence, right? We got these groups together and really wanted to understand the core of the problem, and then bringing these new ideas and different perspectives. And I think that's a winning strategy no matter what or who you are.
Great, great. Well, those were the 5 topics we were excited to address, and we were hopeful that there would be some questions to go along with those. And there's, again, been some magnificent questions that have come in. So if you'll hang tight with us for a couple more minutes, the first one I want to get to is from Dion Bradford. Thanks, Dion, for sending this in. Henry, what are your thoughts on blockchain technology and its application for the mortgage industry? And this is one that, we talk about internally as well. I think it was on a recent episode of This Week Today that Chase Majerus puts out for the industry, which is spectacular. But again, what are your thoughts on blockchain technology and the applications in the mortgage world?
Yeah, I mean, I think it's got lots of applications, right? I think it can power your infrastructure, so it can be used as infrastructure alone, especially the security aspects of blockchain and how you can leverage, I'll call them smart contracts, but applications on top of the data. The data doesn't need to move. So I think that's one area. I think a second area is, truly as a distributed ledger in mortgage, yes, but that's just a long road, right? How do you get all of the different piece parts of the mortgage ecosystem, and there's a ton of them, to participate onto either one blockchain or distributed ledgers across the ecosystem? I know there's people in the industry that are trying to do that, and they will be successful. It's just going to be a lot longer than you think it's going to take. So I think, technology like blockchain has many, many different applications. I think it's turned into a buzzword that means a lot of different things to different people. I know at Fannie Mae, we looked at it in lots of different dimensions. There's promise there. And I just think that's going to be one area that, through, early stage test and learn, I think the benefits of blockchain and distributed ledger technology will be apparent in the coming months and years.
Great, great. Thanks again, Dion, for that. Next question comes from Mary Page. Henry, can you please speak to your thoughts on siloed systems within merging companies? We are, depending on, I guess, your opinion, but a lot of folks would say entering another M&A moment in mortgage and real estate, and in that case, there's obviously, one company has their technology, the other has theirs. Talk about how you would merge siloed systems in some of those examples, in your opinion.
Well, I spent my whole life at Fannie Mae fixing siloed systems, so it's a great question. All companies have them, and they either organically happen or they happen through M&A activities. And I think this is where microservices and APIs allow you to, keep those systems the way they are. I'll use the example of banks sort of drawing a ring around the core. Meaning I've got legacy core. I either don't have the subject matter expertise or I don't have the time and energy to redo my core, so I'm going to build around it. And then leveraging techniques like APIs and microservices to move data in and out is stuff that we've been very successful with, right? And then that allows you then to dynamically sort of keep up with whatever innovation you need to keep up with. And the example I would use is, lots of banks moved to the Blends and the Roostifys of the world for that very reason, right? They didn't really have the time and energy to redo the core or the time and energy to think about user experience when it comes to point of sale. And those companies and others, Simple Nexus and others, I don't like naming names because I'm going to leave someone off the list, but they did a really good job of taking their technology and integrating it into the core, and it looks seamless, right? The consumer doesn't know. And it allows them to bring product to market much faster. And so another benefit of big tech. And so there's a number of strategies that gives you time to get rid of those siloed systems when you're ready to get rid of them versus being pressured to get rid of them because you've got a business imperative to get rid of them.
Fantastic. And there's a few different questions coming in or comments coming in related to can we repeat some of these vendors' names and get a chance to talk about Simple Nexus or HomeBot, whoever might be a little bit more. Others, as you said, same thing. I'll miss more than you will, and so maybe we'll find a way to include some of that in the recap, because I know there's a lot of great companies doing wonderful work out there that we want to get a chance to be a resource for.
Yeah, so the one fintech you should really be looking for is FinLocker. No, I'm just kidding. Just kidding. Now we can put together a list. There's a tremendous mortgage fintech ecosystem, and like I said, I'm going to be unabashed by it. Fintech has been a game changer to this industry, right? And if you don't know who the players are out there and where they play, that's the first thing to do, is get educated on that, because there's a lot of capability out there that can help you solve whatever problem you're trying to solve, right? And then not only solving your problems, but after you solve a problem, then take it to the next level and rethink your business and your business model, right? And that's really the power of these partnerships with FinTech.
Great, great. So again, we're not going to have time for all the questions. I want to be extremely respectful to people's schedules. There's a lot of business out there. There's a lot of happening in the world, and so we want to make sure everyone gets a chance to get back to it top of the hour. But if you wouldn't mind, just as a recap, just giving us an idea of the opportunity that this moment provides, in your opinion, for a retail loan officer or a hardworking realtor out in their communities to make that decision to embrace and grow through FinTech, or I guess choose the alternative and be a little bit fearful of it. And I'm not asking people to feel one way or the other, but I am curious your opinion, again, just on the opportunity that this moment presents to embrace, grow, thrive, serve underserved. If you wouldn't mind just giving us a recap on that before we time out for the day.
Yeah, so I answered it in a couple of ways. One is, we talked about consumer expectations. They have changed and are changing, right? And so you need to make sure that you're keeping up with those expectations. What do consumers want today versus what they wanted 5 years ago, right? And it's no different for mortgage than it is ordering a car through Uber, right? I think number two, you're starting to see the majority of consumers in the mortgage process happen to be millennials and now Gen Zers, right? They are going to expect a whole different level of technology service than maybe others, right? And so you've got to contemplate that. And then lastly, and I'll say it again, right? Your competitor down the street is probably looking at this, right? And there is so much capability out there to understand who the future consumers and home buyers are going to be, what that timeline for first-time home buyers is to purchase their first home. And there's going to be so much opportunity to engage with that consumer before they're ready to enter into that transaction. And a number of pieces of technology that can understand that consumer better, so then you can apply really forward-thinking digital marketing techniques to get to that consumer and draw them into your family, and really create a customer before there really is any transactional capability needed for that consumer, right? And I think that's the work that if people put into over the coming years and months, when we get back to a very strong purchase market, when volumes drastically reduce, it's going to allow you to do one or two things. It's going to allow you to win that business when everybody's fighting over the same business. And number two, it's going to allow you to track new entrants into the market. Those underserved communities or those individuals who have either been intentionally or unintentionally locked out, right? Because they feel like, I don't have credit, so I can't get a mortgage loan, or the answer is always going to be no, so why? I just keep renting. You have the ability to unlock those consumers and get them into a sustainable mortgage to allow them to begin on the road to financial health and wellness. And that's what I'm excited about, where I think the industry is going and where a lot of things have been happening just in the last year alone.
Perfect. Well, what a great conclusion to a wonderful hour. It's been a pleasure getting ready for this with you over the last couple months. It's been a pleasure spending the hour with you. Want to make sure we get a chance to say thanks to Brian and Diana and the FinLocker team for letting us loan you on behalf of the mortgage world and the real estate world, so that you could help us all understand this moment a little bit better. Obviously want to say thanks to you for taking us through that journey and giving us the information that arms us to better serve our customers and be better partners to those that we work with. Again, there will be a recap that'll be emailed out to the attendees, as well as to those that either had to jump early or weren't able to make it. And I would encourage everyone to make sure you reconnect, whether it was a Synergy One Lending person or someone else in the industry that got you the invitation. Make sure you guys get a chance to discuss and continue to enhance the conversation, expand the conversation further, because I think it's good for all of us to be doing that together. So with that being said, Henry Cason, I really, really appreciate it, man. It's been fun. Excited to continue to build my friendship and relationship with you, and hope everyone out there has a wonderful rest of their Wednesday and great start to the month of March.
Yeah, thank you, Ben. I enjoyed the conversation. Thank you for inviting me. And I look forward to, working more closely with you.
Awesome. Thanks, Henry. Thanks everyone for being here, and we'll talk to everyone soon. Bye-bye.